Walmart sales already missed its forecast for this quarter, and now the retail giant says, even though we don't want to, we're going to have to raise prices. The company knows its customers can't afford prices where they are now, but with tariffs raising costs, they simply have no other alternative, knowing full well that the impact on their business is likely to be significant. The latest narrative on the economy from Jay Powell on down is that consumer sentiment may have crashed, but the rest of everything is solid, as the Fed chair describes it anyway, up to and including the labor market. So if it's just negative sentiment, then maybe it's no big deal. Therefore, the macro complacency which has swept over these risk markets. However, we keep seeing all these measures which go much farther than downbeat shoppers, and Walmart knows it, which is why the tone of its latest earnings report was gritted teeth apprehension. To begin with, this isn't only a future concern. Today alone saw an unexpectedly weak retail sales report, especially the GDP component. So there's consumer spending already. Producer prices fell unexpectedly by the most since the lockdowns. The core rate was down by the most in a decade. Wholesale services prices, get this, fell by the most on record. Businesses can't handle the prices they have now, thus Walmart's tone. And that wasn't all. Industrial production experienced an unexpected setback. Manufacturing unexpectedly declined, with output of consumer goods unexpectedly down for the second straight month as the payback begins. Powell says it's just consumer surveys, a bunch of whiners and nothing more serious. What consumers have been whining about is jobs and incomes. They know they can't afford what they have now, so higher prices combined with a lack of jobs isn't some distant, highly remote possibility. And with retail giants worried, retail sales softening, producer prices deeply negative, production already being paid back, are these consumer concerns really that hard to understand? Is it really all unexpected? These are all signs of a fragile economy, not one that's solid. Just ask Walmart. What Walmart reported today was first quarter revenue that increased by 2.5%. to $165.6 billion. But that already missed Wall Street expectations of just over $166 billion. And more importantly, it's also below the 3 to 4% growth rate that the company itself set at its investor day just last month. So coming under expectations only a month later. And Walmart CEO Doug McMillon said, "We will do our best to keep our prices as low as possible, but given the magnitude of the tariffs, even at the reduced levels announced this week, we aren't able to absorb all the pressure given the reality of narrow retail margins." And CFO Rainey continued, "We're wired for everyday low prices, but the magnitude of these increases is more than any retailer can absorb. It's more than any supplier can absorb. And so I'm concerned that the consumer is going to start seeing higher prices. You'll begin to see that likely towards the tail end of this month being May, and then certainly more in June." So they already know. You can hear it. Read between the lines. They know what happens when they raise prices. Their customers can't afford any higher prices, which means as they raise prices because they're not going to sell goods at a loss, as they're forced to raise prices because costs go up, when they do that, customers will begin to disappear. And when they don't disappear, they will cut back on what they spend in other ways. So they pay more for discretionary items, for non-discretionary items, but they're going to have to cut back from discretionary spending. Walmart knows it. Target knows it. Everyone knows it. McDonald's, all of these companies have been saying. The airlines, Southwest Airlines, this is a recession already. This is what they're talking about. The labor market is not solid. It's not just consumer sentiment and consumer surveys. Consumers are concerned because they can't afford the prices that they have to pay now, and raising prices is going to lead to a whole bunch of negatives, which is what we're always talking about. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with monetary metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. Even if it's not priced into the stock market right at this moment, even those stock market observers are becoming a little bit more antsy about the direction of the macroeconomy. As Bloomberg reported after Walmart's announcement, this rally is getting tired, according to Jeff Buckbinder, who's the chief equity strategist at LPL Financial. Soft retail sales, energy weakness, oil prices, big one, and cautious commentary from Walmart reflecting a still challenging trade environment are all enough for stocks to take a breather. And it's not just sentiment, it's not just corporate anecdotes. We continue to get evidence for all of this on top of everything. Today, we got retail sales, producer prices, as I mentioned, as well as industrial production, and it's all one complete package. Consumers aren't afraid over nothing, it's actually happening. To begin with, the retail sales report for April, the Census Bureau undertook one of its annual benchmark revisions, which substantially reduced nominal retail sales for the last several years. Just to give you an example, January 2023, under the old benchmarks, the Census Bureau estimated retail sales, total nominal sales were $693.8 billion. Under the new benchmarks, which just came out today, for January 2023, the census now says it's $680.3 billion, a substantial, nearly $14 billion difference, a 2% miss. So a significant downgrade across the board. For example, May 2024, initially estimated, or at least the last benchmark revision had it at $704.3 billion, now $691.2. And even last month, for March of 2025, the old benchmark said retail sales were $734.9 billion. Today, they think it's only $724.1. So significantly weaker consumer spending over the last several years, along with the labor market data that we keep seeing revised downward, it indicates that the economy everybody thought was up here, strong and resilient, solid, that's the new term everyone's using, was actually a little bit less and creeping in the wrong direction before we even get to tariffs and trade wars. Under the new benchmarks for the month of April 2025, retail sales rose in nominal terms by just 0.1%, which was either above or below analyst expectations, depending on which calculation of analyst expectations you use. But it doesn't matter. It was basically flat after a sharp increase in March, which was due to the splurging ahead of the tariffs. Everybody bought, especially automobiles and cars, trying to get them before costs rose. So we had the big splurge in March and then flat sales in April, which suggests there's still some splurging going on. It hasn't really started to pay back, but it certainly is weaker than most people are anticipating, especially when you get into some of the details. Real retail sales in the month of April were negative. If they're basically flat in nominal terms, then given the CPI, even though it was low, it was still positive. Therefore, real retail sales were down 0.2%. And then the control group, which feeds into GDP calculations. This is retail sales, which exclude food services, auto dealers, building material stores, as well as gasoline stations. Now, the control group had increased by 0.5% in March, so somewhat of a splurge ahead of tariffs, and economists were expecting it to continue to rise, at least at a lower rate, 0.3% here in April. But instead, the control group fell by 0.2%. So that was a huge 0.5 percentage point miss to expectations. Not only was it a 0.5 percentage point miss, it flipped the sign around too. So soft retail sales all around, all the data, as well as all of the internal details. And as such, it caught the media's attention as unexpected weakness. Here's an example. After loading up on purchases to front-run President Donald Trump's tariffs, the figures suggest consumers are tempering their spending. It's not just sentiment, and will fuel concerns of weaker economic growth. Companies, investors, and economists are cautious on the outlook as consumer sentiment sours. So it starts out with sentiment, but it's not staying to sentiment. It's already an activity. And we've talked about other forms of activity that show the same thing, like consumer credit, which is weak as well. And it wasn't just Walmart. Here's another CEO, Mark Levine, who's the CEO of Energizer Holdings, the bunny. In his conference call from a week ago, he said weakened consumer confidence and persistent inflation across the store may pressure volumes in the short term. Pressure volumes. When we pull all this together, tariffs, consumer confidence, and overall demand, which is weak, not solid, We have tempered our outlook over the remainder of the year. And it's the same thing everywhere. Everyone knows, yet they don't want to say it. They don't want to come out and say it explicitly. Everyone knows raising prices in this environment is the kiss of death. Volume just disappears. We've seen it time and time again. The economy is not solid. It is indeed fragile. And these are all signs of that fragility. You raise prices by a little bit, the incomes aren't there, the jobs are not there, there's no way to make back that lost purchasing power, and so something else has to suffer. Somebody else in the economy, whoever benefits for price increases, which is not much, the rest of the economy has to adjust in a very negative way, starting with consumers and households. That degree of substantial and really constant weakness is one reason why we saw consumer prices in the month of April, the CPI, well under expectations. But now the producer price index actually obliterated the consumer price index and going in the wrong direction, at least wrong direction for the macroeconomy. So while the CPI showed a 3-month period of unusually strong disinflation really since February, the PPI, the producer price index, goes even farther. The overall PPI for the month of April 2025 fell by 0.47% month over month, which is the largest single month decline since April of 2020. That brought the year-over-year change down to 2.4%, which is the lowest since last September. But again, unusual weakness here in the short run. The loss of economic momentum we keep talking about, because this is all driven by demand, lack of demand, more than anything else. The core PPI, that one fell by 0.44% on the month, which is the biggest monthly decline for the core PPI since 2015. And in the services sector, where we've already heard about airlines talking about how they can't fill their planes and they've had to cut costs, wholesale services prices beyond just strictly airlines, that one fell by 0.68%, which is the most on record. Now, admittedly, the series only goes back to 2009, but still you're talking about 15 plus years, a decade and a half of data, and this is the worst month for services producer prices in the entire series. And even in producer prices that economists prefer to look at, which is a less volatile series, this is PPI trade ex food and energy. That one declined by 0.11% month over month, which doesn't seem as impressive as the other ones, but you have to realize this one, which is meant to smooth out all the volatility, therefore this is the first decline in April 2025 in this series since April of 2020 as well. And the 2.95% year-over-year rate brings it down to the lowest since last February. And of course, like I said in the introduction here, all of this is unexpected. Economists and analysts were expecting the producer prices to go up in April because of tariffs, but instead they've gone down by a whole lot, by an almost historic amount, simply because demand isn't there. Businesses are realizing they can't pass costs on to other businesses, let alone their customers. But this is all unexpected. As Bloomberg said, prices paid to U.S. producers unexpectedly declined in April by the most in 5 years, largely reflecting a slump in margins, which is exactly what consumers are afraid of, suggesting companies are absorbing some of the hit from higher tariffs. Like I said, that's what's driving consumer sentiment down into the dumps anyway. Consumers know that what they're afraid of is, first of all, any price increases means they can't afford things. But number two, maybe more importantly, they know that prices go up, for the business cost prices go up. It just squeezes business margins, which means companies are going to react in the same way that they always react, by cutting back on labor costs, cutting back on hours, cutting back on wage gains, cutting back maybe, if we're not lucky, also on workers. That's why we keep seeing job finding fears that are down in the dumps too, and job losing fears or job loss fears are surging ahead. Because consumers know the environment that we're in here. It's nothing like what everybody says about solid strength and resilience. It's not inflationary either. It's a fragile economy that's reaching its limits for all of these dimensions. Back to Bloomberg. The figures suggest American manufacturers and service providers are so far refraining from passing along higher U.S. duties on imports. The impact on consumers has been modest, even as producers are feeling the pinch from aggressive levies on imported materials and other inputs. And like I said, with consumer prices, These businesses are not doing it out of the goodness of their heart. They would definitely pass along every last penny and then some to their customers, whether they be businesses or consumers, if they thought they could. The fact that producer prices fell as much as they did and consumer prices were much weaker than expected, even with tariffs being introduced in the economy, tells you everything you need to know about the ability of the economy to absorb even the smallest increases, let alone substantial ones. As Walmart was saying, as Walmart was trying to imply, reading between the lines, they know what's going to happen when they're forced to raise prices. Consumers know it. Everybody knows it except economists, central bankers, and the media. This is all unexpected only to the public who gets their news and follows the economy from the mainstream. And so with that fragile environment, consumer spending already softening up, apart from the splurge in March to get ahead of tariffs, and with producer prices showing how much difficulty there is on margins, everything being pressured, is it really unexpected that manufacturing production, especially for consumer goods, was weak again here in April? Well, according to the mainstream, yes, it was all unexpected. As Reuters said, U.S. manufacturing production fell more than expected in April amid a sharp decline in motor vehicle output, and the sector could struggle to regain its footing in the second quarter because of tariffs. But the Federal Reserve did report for industrial production in April was a slight negative, minus 0.01%, so a fractional drop in the month of April. That was following a little bit bigger of a decline, 0.25% in March. But manufacturing production, which had been boosted in March on tariff front loading, gave it all back, down 0.4% in April after being up 0.4% in March and up 1.1% in February. So you can see the majority of the artificial high hit in February for manufacturers, and it's being paid back a little bit in March, but much more in April. And it's going to be paid back even more moving forward, May into June, especially given all these other details that we're talking about with consumer spending, not just consumer sentiment. And consumer goods production, according to the Fed, was down for the second straight month. The payback has already gotten to be pretty substantial there. Output of consumer goods was minus 1.1% in March and then negative minus 0.18% in April. Remember, with industrial production, these statistics are volume numbers, not price-adjusted numbers. So these are strictly volume. And that brings the consumer goods index back to below where it was last summer. Again, artificial high that wasn't all that high to begin with, and now the payback that just adds one more negative on top of everything else. The reason these are all signs of fragility, it's not just lost purchasing power from several years ago, it's also about the labor market itself. And I've been trying to point out consistently how the jobs market and employment has been much worse than people have been aware of. Even the data, like the payroll reports, they've been revised substantially lower because the economy was never as strong. And we're getting more evidence of that here with retail sales and the benchmark revisions. The economy was even weaker than everybody thought. It wasn't all that great to begin with. We see that in a range of data sources, including something like the Business Employment Dynamics Survey, which I call the BED. It used to be called the BED survey. Now it's BDM, according to the BLS. That showed negative net jobs in the second and third quarter last year, the latest figures that we have. So even before we get to this year, the labor market was in deep trouble to begin with. As I pointed out in the recent video, a negative quarterly change from the BDM survey is incredibly rare outside of recession. There had been one outlier quarter in the middle of 2017, but that's basically it. And this isn't in a single quarter. This is 2 quarters in a row, and it's 3 quarters of the last 5 where the BDM survey suggests that net jobs were negative in a whole quarterly period. So in other words, it's consistent with a fragile labor market, lost purchasing power, all of these things coming roaring back to the forefront here in 2025. And consumers know this isn't just pessimism for the sake of pessimism. They know that what this means for themselves as well as for their employers. Their employers are going to be squeezed. And as bad as it is for consumers, it'll be even worse if their employers do start to act on all of these margin pressures. Because unlike the passive tone in all of these mainstream media articles, businesses they're not absorbing costs because they want to do a favor or a solid favor for their customers. They're doing it because their customers can't afford the price increases. So you've got Walmart who knows exactly that, yet they have no choice. That's what they kept saying on the conference call. We don't have any choice with costs going up and with retail margins as thin as they are. We have to raise prices, and we're just going to grit our teeth and hope for the best. Consumers are already paying back after the splurge, and it only gets worse. This is not just about sentiment. Consumer spending has softened, certainly as a baseline, for some time already. Producers, they're cutting back on production. The payback period is beginning there, and prices show the difficulties that they're experiencing on everything else. Unexpected weakness? No, it's unexpected because everybody's been listening to Jay Powell go on and on about a solid labor market contributing to a strong and resilient economy, that all these data series are saying, well, yeah, we maybe thought it was kind of strong and resilient, but now we're revising everything lower to begin with. When you put it all together, trade wars didn't break the economy. Even Walmart talking about rising prices, that they're describing a fragile situation. So if trade wars didn't actually break the economy, trade deals are not going to be able to fix it. Instead, all of these things, retail sales, Walmart, retailers, negative producer prices, this deeply negative, production, lower production, these are all signs of a fragile system, and a fragile system that really can be pushed too far. And another system and economy and country that's being pushed too far, that's China. The banking story there is one of the most important ones we've got going, and I went over the details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.